Hey everyone, Kris Barney from 3040 Wealth here. Today, I'm really excited to dive into our newest video, the IPO Millionaire's 180-day playbook. If your company just IPO'd, this one's for you. How to make your lockup into a strategic advantage. Let's dive in. 2025 has been a really exciting year. For the first time in the last 3 to 4 years, the IPO market feels open again. A lot of really exciting companies have gone public, and a lot more are likely still to come. For you as an employee, it's likely been a long wait. So first and foremost, congratulations. And now that it's happened, you have this big question. What should you be doing now while you're locked up? In the 90 to 180 days that your company is locked up, you have a very good chunk of time to think through and develop your plan, and that's an opportunity you want to be taking advantage of. Whenever I guide a client through this, I always recommend that they focus on this with 3 prioritized steps. First, develop your financial plan, knowing where you want to go and why you want to get there. Once you have your personal financial plan locked down, then you shift over to creating your equity and investment strategy. There's a lot of different ways that you can approach this, and we'll dive into that in a little bit. Last, once you have both of the first 2 things figured out, then you want to be thinking about optimizing for taxes. In many situations, we can save 3 to upwards of 8% at times, and in rare situations, it might be more than 20%. But you definitely want to make sure you get the first 2 items focused on first before you start trying to dial this lever. So with that as our prioritized focus, let's get into the first one, developing your personal financial plan. Where we start off is taking really good stock of where are you today. The assets, the liabilities, the income, the spending, and other things even like insurance and estate planning. Before we can go anywhere or plan for the future, you want to know where are you exactly today from a financial standpoint. Second, it's spending time, if you haven't already done it, really thinking through where you want to get to. What do you want to be doing 10, 20, 30 years from now? Are you desiring to start a company? Are you wanting to take a sabbatical? Are you wanting to retire early if it's possible? There's a lot of really great options, and your money should always be in service of your and your family's happiness and your life goals. Once you've figured out where you are today and where you're trying to get to, that's where financial planning dives in. And there's a lot of different elements of that, from planning your savings rate and your cash flows, planning your investment strategy, your equity comp, especially post-IPO, plays a really important role, as well as optimizing for taxes, things like insurance and estate planning. All those items play in. But knowing where you are today and knowing where you want to get to long term, then you can connect those dots through financial planning. Starting with the first step, where are you today? In an ideal world, you're going to want to take stock of everything, from your assets, your liabilities, your cash flows, income, expenses, savings rates, all of the different elements. But if you're trying to say, Kris, what are the key things that I really have to be dialed into? We narrow it down to 5 items, that proverbial 80-20 rule. You should have a really good idea of what your income is and your spending, which determines what your savings rate is right now. You should understand what your asset base is and what investment strategy you have and what risks you're taking as to how that might translate to a targeted rate of return over time. And then last, how taxes are going to affect that holistically across the way. Second, what are your goals? I say to pretty much every one of my clients, your money should be in service of your happiness. Everyone has different goals. Everyone has different situations, different timelines. So you should really be sitting down and thinking about what is it that you and your family, if you have one, are trying to accomplish. The spectrum can be really large, but sitting down and thinking through where is it that you might want to go and on what timeline do you want to get there is a really healthy exercise, and also is what's critical to help us align to the next step, which is how do we actually chart that path to get you there. All right, so with steps 1 and 2 complete, now we're going into the implementation mode. If you look up on the screen here, there's 3 stars because that's what we're going to dive into today. How do you develop your equity comp strategy? How do you align what we already talked about, the goals and values? And how do you optimize for tax? As you can see, there's a lot more on the screen. If you're doing a holistic approach, which is how we work with our clients, you would dive into all of these. But the 3 ones that are starred, those are really critical, and those are the ones that we want to give you insights into today. All right, part number 2, how to think about your company equity and how to develop a plan for it. First and foremost, please avoid doing nothing. The whole, I didn't know what to do, so I didn't do anything. This is actually the most common regret that I hear from prospective clients that come to me 6, 12, 24 months after the IPO. Doing some planning is always better than doing no planning, because doing nothing is a choice, even if you didn't actively intend to do it, And many times it's going to put you in a situation that you are not happy about many months or even years down the road. As you're diving into developing your plan, the first thing I want to encourage you to do is what I call deprogramming your brain. The top question most people have is, should I sell my company stock? And it makes total sense because you have a significant amount of your net worth now exposed to the company that you work for. And what's a little ironic is that if I asked this to anyone else with any other stock, 98% of the time or more, people wouldn't consider having that much of their wealth tied to one stock. But because it's a company you worked for, because you had equity comp, and because it's now becomes worth a lot more, there's a number of different psychological factors that might bias you to thinking that you should hold this when, if you can deprogram your brain, you'd probably think about it differently. As we start to develop your plan, if you're one of those people that likes to jump straight to the answer, here's how I would frame it. More than 80% of the time, an individual would probably be better off selling all of their stock either immediately or via a selling schedule over probably typically 1 to 2 years. That doesn't mean that you can't hold some or all of it long term. As you can see in the flow chart, there's a couple different scenarios where it can play out, where that can be the right decision for you. And I have a number of clients I've helped develop plans to hold a significant amount of stock long term. But 4 out of 5 people, the better choice is definitely developing a plan to diversify and sell out of their stock. And above, there's these 3 steps that you can think through in order to figure out, do you fall into the 80% bucket or might you fall into the 20% bucket? Now, as you look at that flow chart, you might be saying, Kris doesn't really know my company. And you're 100% correct. I do not know it nearly as well as you do. But that actually can be a strategic advantage because as someone who has deprogrammed my brain relative to your company already, what I can do is be much more pragmatic. There is a common saying that concentration can build wealth, but diversification preserves wealth. From this point forward, what I leverage is data. And what is up on the screen here is a number of different situations that detail over every stage of a company's life, whether it's pre-IPO, soon to be IPO, recently IPO'd, or a mature public company. In all of those, the average returns are significantly skewed by outliers. And if that's the situation, then you have to ask yourself, is my company an outlier? And I totally get it because it's already an outlier. It has made it to IPO, which is rare for a startup company to do to begin with. But once it gets to IPO, there are thousands of publicly traded companies. And the data says that 96% of them underperform if you just invested in US Treasuries, which means there's only 4% that have stellar long-term returns and justify those really attractive returns that the overall S&P 500 has. But it's something you really want to internalize and think about because even though your company has made it to IPO, it is by definition an outlier. But to continue to outperform the S&P 500, it needs to continue being an outlier. And it doesn't mean that I'm saying your company isn't great or amazing. There's tons of amazing companies. What I'm saying is that I don't have the emotional attachment that you do to your company. And by following the data, looking at companies similar to yours at every single stage, like the data that I've shown up on the screen from NASDAQ, demonstrates that post-IPO, more than 70% of companies underperform the index. And even when you get to the largest of large companies, if you're going back 20 plus years and look at the S&P 500 from 2004 versus 2024, 6 out of those 10 companies literally declined in value. Not just underperforming the S&P 500, 6 out of the 10 of those declined in value. Another 3 of those underperformed the S&P 500. Only 1 of them outperformed the S&P 500 by a significant margin. And these were the top 10 largest companies in the S&P 500 in 2004. It just illustrates that concept that whether you are pre-IPO, recently IPO'd, a publicly traded company, or one of the biggest publicly traded companies, everything is skewed by outliers. And because of that, on average, if we're thinking about your company, typically the data suggests that not taking single company risk is going to be a better wealth preserving strategy versus maintaining concentration risk by continuing to hold a significant portion of your company stock. All right, so now let's get action oriented. How do you actually create a plan to diversify out of your company stock? With all of my clients, we approach this with the framework that I'm showing on the screen. It's a 3-tier process. First, we think about how much makes sense to sell pretty much now or when the lockup expires. The middle part I'll get to in a second. And then the third part we focus on is how much makes sense to keep for the long term, if any. Once we figure out how much we want to sell now and how much we want to keep for the long term, then we get to the middle portion. And in the middle portion, this is really where we typically approach this by having a selling plan. Depending on how much risk you do or don't want to take with your company, we can build this in a couple of different ways. The most common is to create a selling schedule, such as I want to sell an equal number of shares every month or every quarter over the next X number of years, maybe 2 or 3 years. It gives you roughly what your company's average price might be over that time frame. And many individuals psychologically, that's a comfort zone to them and feels fair to them. Totally great. That's why we use it a lot. At a high level, this is designed to be flexible and really tends to skew based on your risk tolerance. If you have personal financial goal needs of this, or you fall in the 80% bracket where you should most likely be developing a diversification strategy, your bias should be significantly on the sell some now and sell some over time. If you fell into that 20% category where you think you want to hold a significant amount of this over time, you should be a little more skewed toward the keep some for the long term, and probably on the selling plan side, at least be using some form of a target pricing strategy. Double clicking on how much to sell now, this is how we think about it. It's really a max of 6 different inputs. We start off first thinking about the amount of money you've invested into the company via foregone salary or directly invested. The second, your risk profile. If you have a low risk tolerance, you probably shouldn't be taking a significant amount of single company risk. Third and fourth, your near term as well as your long-term financial plan needs. If those aren't met yet with cash, you usually don't want to be taking single company risk. You rather want to diversify and sell out of that in order to meet those needs. Fifth and sixth, the amount you'd like to sell as well as the company downside risk. If you have a certain amount that you'd like to sell, that's usually a pretty healthy approach. And if you don't think pretty positively about the company's long-term investment prospects, you probably shouldn't be holding much of it to begin with, and therefore you should be planning on selling a pretty significant amount near term. Last, let's talk about if you are one of that kind of 1 out of 5 where you want to hold a significant amount of company stock. I've helped many individuals through this. It's right in certain situations, but when you're doing it, you still want to need to have a plan, not just, I want to keep this for X number of years. Here's the reason why. If you're holding a significant amount of company stock, you are functionally making a very high risk, very intentional investment decision. This is done many times. You look at hedge fund managers or mutual fund managers that hold concentrated stock in a portfolio. They can do that, but they're all doing it with a purpose or an idea in mind. At a high level, what they're believing is, I don't believe that today's stock is fairly valued. I believe that the company's stock price should actually be significantly higher. Great. If you have the skills and experience to do this, and if you think that way, then just write it down. Develop a plan. Why do you think your company stock will outperform? What assumptions need to happen to prove you right or wrong? And when do you believe that's going to occur by? And then last, even once you write that all down, you need to be checking in on this frequently. And you need to have an exit plan for if things go well and if they don't. If things go right, at what price do you think you should be selling out of your company stock? There isn't an unlimited ceiling for any company. If the idea behind holding a concentrated stock is, I believe this company is undervalued and it's going to perform significantly better than the overall stock market, okay. But if it does do that, if you are right, at what point in time is it likely to be in line with the stock market's performance or under it? Those are your selling points, and that's when you should have that strategy. And alternatively, what if your assumptions don't prove to be correct? What if the company doesn't meet its expectations? Every good investment philosophy has an upside scenario of how they'd exit and also a downside scenario or a risk management approach to how they'd exit. And you want to make sure that you have the same. With the first 2 items tackled, now let's dive into the third one, tax planning and strategy. There are more than 13 different types of taxes that we consider. And for equity compensation, overall owned equity and stock and income, there are more than 50 different strategies that are relevant or prospectively relevant. So there's just a lot to navigate here. What I want to do is simplify this for your particular situation here in the lockup phase. Over on the income tax strategy side, there's 4 that we're going to dive into. Over on the capital gain side, there's 7. And then there's also in between both of those that have both income as well as capital gains elements. There's an additional 3 there. So with this kind of as the high level, we're going to take a quick look at each one. Let's start with income tax strategies. The first one on the list here is maximizing deductions in high income years. The High level approach to this is that if you have a high income year, like a year that your company IPOs, and if you have double trigger RSUs that vested, it is likely that the marginal tax bracket that you have this year is materially higher than the marginal tax bracket you'd have in a non-IPO year. And so the strategy and what you want to be thinking about here is, are there any things you can do this year when your income is abnormally high to reduce that overall income? There's the simple approaches such as maximizing your 401k. If you're married, making sure your spouse maximizes their 401k. Things like HSAs or FSAs, as well as what I'll talk about in a bit, which is charitable donations. The second one here, ISOs and AMT. I actually spend a lot of time on this with my clients, and look, it's complex, but let's make sure you at least have the high level specifics. AMT is basically a dual tax system. Whether you know it or not, your taxes are calculated two different ways every year. First, the regular way, and second with AMT. And in most years, because the AMT side has a significant deduction, your standard taxes are larger than your AMT taxes, and you have this window of opportunity you could realize from exercising ISOs without actually ever triggering an AMT bill. But if you have triggered an AMT bill, it's not the end of the world. It just requires a lot more strategic planning. What happens is the amount above your standard tax that you incrementally pay for AMT, you get a credit. And in every future year, you have the ability to test and recoup some of those assets. If your standard taxes for that year are actually higher than your AMT, that delta, that's what you're able to get back. There is a lot of nuance and a lot more that goes into this, but this is it at a high level. And if you haven't already exercised the ISOs already, if you have them, now that your company's public, there's a lot of interesting strategies and ways we can approach this. But at a minimum, making sure you understand AMT and try to manage around it, both from how much do you incur, and then in the future, how much can you recoup back, is definitely something you want to be focused on. Third up, NSO exercise strategy, and again, managing your tax brackets. If you have NSOs, especially now that your company is publicly traded, the difference between your company's stock price in the market and the strike price of your NSOs, that per share is going to be taxed as income. And so the way you manage around this is twofold. One, strategically and intentionally thinking about how much income you want to incur in a year based on the tax brackets that you're in, combined with how many of those different levers we already talked about of the different deductions that you might manage to bring that down as well. Let's say your income puts you middle of the way through the 24% tax bracket at the federal level. That means at some point in time, if you exercise too many NSOs and generated too much income, some of that would eventually be taxed in the 32% bracket. But if you manage it out and figure out how much you might want to incur, you can incur 10, 20, 30,000 or more. In this case, it's almost 50,000 of incremental income while still staying in that 24% bracket, but not crossing into the 32. All else equal, this can save you some tax dollars. Last, I'll talk about what I call uncommon income tax strategies. All of these are valid. All of these exist. I think many of them end up being overhyped and or inaccessible for a lot of people, but let's briefly touch on all of them just to make sure you understand what they are. And if it is a situation that might make sense for you, then it could be something that you might want to explore. The first one here on this list are select hedge funds. First, I'll lead with the challenging news. Most individuals probably can't access this. It requires an individual to be a qualified purchaser, which means they have investable assets in excess of $5 million. Additionally, for the way that it works, it probably means that you actually want or need to invest around $5 million or more into a combined strategy of the hedge fund plus another strategy. But if you can meet those requirements and want to, it can be interesting. Here's how it works. First, you start off by investing in the hedge fund. Let's say that you put $500,000 into the hedge fund, and what the hedge fund does is it trades frequently, which generates a lot of gains and a lot of losses. But the character of each of those is a little bit different. The losses end up typically being classed as ordinary income, and the gains end up being typically classed as short-term capital gains. If this was the only thing that you did, it probably doesn't accomplish much of anything for you because short-term capital gains are taxed at pretty much the same rate as ordinary income. So other than the, on average, historically positive return these funds have typically had, it doesn't do much. But if you look at the second column, typically known as like a 1-30-30 strategy, the way that these strategies of 1-30-30 work, they typically generate long-term capital gains, although those aren't realized. They're not actually generating realized. It's just, there's gains that are occurring here. And they also generate short-term capital losses that typically are realized. And when you look at the combination of these two, that's where it prospectively gets interesting, because you end up getting a realized ordinary income loss, no short-term capital gains because they net against each other, and an unrealized/deferred long-term capital gain. The second and the third one are real estate related. Over on the short-term rental properties, the way that real estate works is that you have depreciation for assets, which is a non-cash expense. And so there's a world where investments can have actual cash flow levels of returns, but on paper show a loss. Those losses on the rental property for a year can offset earned income. For the real estate tax professional status, this is actually an IRS mandated rule of whether or not you qualify under a real estate professional. This doesn't mean that you or your spouse is a real estate agent. There's a number of more broad spectrums that qualify for real estate professional. You, working in tech, I'm pretty darn confident you don't qualify. But if you are married and your spouse either naturally works in this industry or in rare situations has a strong desire to work in the real estate industry, same pseudo concept for number 2 applies. If you invest in property or you own it directly and those properties have a taxable loss, that loss to a certain cap can offset earned income. Last, oil and gas and solar investments. I would discourage most people from exploring these because the reality is that there's a lot of big dollar players that tend to invest, especially in oil and gas. And if you happen to get access to a strategy, most of the time it's been a market for lemons. A lot of other really talented people that know how to diligence oil and gas investments have already passed here. You don't want to invest dollars just for a tax saving element in oil and gas if it's not a good investment overall. But if you did have experience here, oil and gas investments can be interesting because when you invest in them, usually you have to go develop the well. And that's a lot of upfront cost. And those upfront costs are able to offset your earned income. And then you get the payout over time at more attractive tax rates. Next on our list is dual income and capital gain strategies. The first one we're going to dive into here is donating to charity and doing it in a tax smart way. So this is how this works, and it can be really interesting if you're charitably inclined. As you see in the image here, if let's say you had $100,000 of stock and it was acquired at such a low basis that I'm going to assume it's basically $0. So you have $100,000 of capital gains. If you donated this stock to charity, first thing, you get to avoid the long-term capital gains and associated state income taxes on this. So 24% from the state, and let's say you're in a high cost of living state where you have another 10% or more. So you get to avoid that 34, 35, or even higher percentage cost of selling a stock that is really highly appreciated. Second, by donating it, you get the write-off for your taxes, and you get the write-off of the full 100K, not the net of other taxes that you otherwise would have had. So if you donated 100,000 of stock, you get to write off that against all of your income up to a certain limit. It's typically 30% or more per year of your total income. But if you combine those two things together, it can be really powerful. If you look at the examples detailed on the screen, let's say you live in California or New York and you did this. Well, you would save 34% or more on the avoiding the long-term capital gain. And then if you were in the 37% tax bracket and 11% state, that's another $48,000. That 35,000 from the capital gains plus the 48 from the income taxes, you've effectively avoided $83,000 in taxes by donating $100,000 of stock. Obviously, that's not net worth accretive, But if you are charitably inclined, being able to have $100,000 to give to any charity or combinations of charities that you want to give it to for a net cost to you of only net of tax of only $17,000 is a really powerful way to be able to amplify your charitable giving. And as you might expect, these tools also help you manage your capital gains and manage your income if you use them in those strategic years. Staying down the charitable path, the second strategy is a charitable remainder trust. There's a handful of charitable trusts, so a CRUT, a charitable remainder unit trust, isn't the only one that is worth exploring prospectively, but I do believe in this situation it could be the most interesting. Why it's unique is it allows you to diversify out of your company stock pretty much immediately once you have the assets in there, but you don't actually realize the tax bill until year or many years down the road. And you get to decide what it looks like. So let's say, for example, you set up a charitable trust. You have to make sure that it's set up at least so that statistically it's supposed to give at least 10% to charity. So if you put $3 million into a charitable trust, 10% of it, or $300,000, would be statistically determined to be given to charity. And in which case, the year you set this up and put the assets into the trust, benefit number one, those $300,000 become a write-off against your earned income as long as you don't exceed the limits. Next, once you get that $3 million of stock into the charitable remainder trust, you can sell it immediately to diversify. But even though you've sold it once it's in the charitable trust, you're not recognizing a long-term capital gains tax bill for likely many years to come. Let's say that you set this up for 10 years. So you decided that over 10 years, this trust needs to pay you back the money every year that you invested into it, up with certain rules. So let's say it has a rule where 10% of the trust assets are to be distributed to you every single year. So in year zero, you put the $3 million in. Year zero, you get the $300,000 tax write-off for that remainder unit that's going to go to charity. And then years 1 through year 10, you get 10% of the assets that are in the trust distributed out to you, say December 31st of every year. Let's say that first year the portfolio grows by 10%. You sell immediately, then you diversify, and that portfolio grows by 10%. Year one, you've got 3.3 million at the end of the year. 10% comes back to you, and 330,000 is distributed out to you. When that distribution occurs, that's when the taxable element occurs. You get the cash back to you, and when that cash comes back to you, it has some taxable event associated with it. But if you manage this intentionally and strategically, a lot of people can set it up so that you get that immediate diversification benefit, but then over time, you are able to intentionally have it distribute only long-term capital gains to you every single year. You're able to have a diversified portfolio like the S&P 500. And very interestingly, with other strategies that I'll talk about in a bit, you can pair the distributed long-term capital gains that are coming from the CRUT every year with harvested tax losses from other parts of your portfolio that you already own personally in order to try to reduce that tax bill as well. The last item that we'll talk about here is state relocation, specifically to a lower tax state. This can be interesting from two different vectors. First, on the capital gains perspective, stock is considered property. And because stock is considered property, you are allowed to take that from one state to the other, and whatever appreciation occurred in the state that you were living in, it does not matter. So let's say you bought, again, effectively really low basis stock while you were in California. You did an 83B exercise when you joined the company. And now your stock is worth $6 million and your tax basis is almost zero. If you sold it while you were in California, you would owe long-term capital gains as well as California tax. So that kind of 24 plus 11 you're seeing on the screen. But if you moved to a lower cost state such as Texas, that you can avoid the capital gains on. And in which case, if you waited in that same scenario until you moved to Texas, instead of 24 plus 11, you would only have 24. So it can be a really strategically significant tool if you are wanting or at least open to the idea of relocating to a different state. If you're not, this obviously doesn't work. Now, because this is dual income and capital gains elements, what's the income element? Let's say you had an RSU that's a 4-year grant. You're living in California. You vested 2 years of it. You still have, as long as you plan to work for the company, 2 more years to fully vest into it. If you were able to and wanted to relocate to Texas and your company's okay with it, while those first 2 years that you had living in California are going to be subject to California taxation, those next years that you vest into while you're living in a low or no tax state, those aren't going to apply. And in which case, it can also help reduce your income taxes too. Last, let's talk about capital gains tax strategies. The first one we're going to get into here is selling stock smartly by tax loss management and timing. So what you want to do is make sure you understand what your capital gains tax brackets are and also what are known as your tax lots. Tax lots are a really important thing to understand. For example, on the screen, you can see that there is lot number 1, which is appreciated 150%, and lot number 2, which is appreciated 300%. In this situation, when you go to sell, if each of these had an equal amount of shares, say 1,000 each, and your goal was to only sell 1,000, you're going to pay a lot less tax by specifying that you want to sell lot 1, which is up 150%, versus lot 2, which is up 300%. And so trying to figure out and understand what the different lots are that you have and specifying which ones you want to sell when you sell can actually really help you manage your tax bill. Second to that, let's also figure out timing. Timing can play into account in a number of ways. First, making sure that any shares that you sell at gains are typically in the long-term capital gains tax treatment relative to short-term capital gains, which is a 1-year holding period. Second, understanding what your tax brackets are for each year and how that relates to both your federal as well as your state tax if applicable, and which year or years you might want to strategically recognize certain gains in can help you manage that as well. So both from a bracket management perspective, a timing perspective, and a tax lot perspective, there's a lot of things that are going into play here. Now let's talk about tax loss harvesting. The federal government and pretty much every state follows a tax loss and tax gains offsetting mechanism. What it means is that if you have a capital gain that you've recognized, you can also recognize capital losses. And when you go in to pay taxes for a year, those net against each other. So like you see in the example here, if you had appreciated company stock, you bought it at 100 or your RSUs vested at 100 and now it's worth $150 a share. If you sell it, you're recognizing a $50 capital gain. But if in your personal investing portfolio, or maybe you have other company stock where it vested at a much higher price and it's actually down, you have a capital loss if the price that you purchased a stock at is higher than what it's currently selling at. And if you sold those shares, you would recognize a capital loss. So in this example, let's say the stock price is 50 of a stock you bought at 100, then you have a $50 loss. If both you sold that company appreciated stock and you sold that stock at a loss, the $50 gain and the $50 loss would net to be zero, and you actually don't have a tax bill. So tax loss harvesting can be a really important tax planning tool. All right, so let's talk about what we call accelerated tax loss harvesting. This one's really interesting, but it's also a little complicated. Let me break it down. When you invest in something like the S&P 500, there are a few different ways to do it, and the way you choose can have different tax implications. The first and most common way is simple. You just buy an S&P 500 ETF. It's straightforward, easy to manage, but limited tax flexibility. The second way is called direct indexing. Instead of buying one ETF, you buy a basket of individual stocks, maybe 150 or more, that when combined closely mirror the S&P 500. Why do people do this? Well, mainly for tax purposes. Let's say the S&P 500 goes up 10%. If you hold an ETF, your ETF is up 10%. That's great, but you don't have any losses available to harvest. With direct indexing, it's different. Even though your portfolio overall might be up 10%, within that basket of 150 stocks, some companies are up much more and some are actually down. That means you can sell the stocks that are at a loss, recognize that capital loss, and use it to offset gains elsewhere, like the gains from your company stock post-IPO, which collectively helps reduce your tax bill. Then there's the third approach, sometimes called the 130-30 portfolio, or what I call accelerated tax loss harvesting. Think of it as direct indexing, but amplified. Here's how it works. Imagine you invest $100 in direct index S&P 500 portfolio. That's your normal exposure, 100% long. But with a 130-30 portfolio, you have that same 100, but you actually add an incremental 30% to be long 130, and you also short sell 30%. So your net exposure is still 100% to the S&P 500, but instead of just owning $100 long, you have $130 long and $30 short. And here's why it's different. Short positions make money when stocks go down and lose money when stocks go up. It's the opposite of traditional investing or when you're what is known as long. So when the market moves, whether it goes up or down, you're much more likely to have at least some losses you can harvest because the long side and the short side are directly contradictory to one another. And that's why the 130-30 approach can be so powerful. It creates more frequent opportunities to capture tax losses, which can then be used to offset gains that you probably have from your company stock. Double clicking on this for a second because we get a lot of questions about it. What you're seeing on this screen are a couple different examples from one of the more popular and large direct indexing and 130-30 providers. So in the first chart, what you're seeing is how much capital losses per year relative to how much you invested might someone that's using a direct indexing strategy or a 130-30 portfolio expect. In the first image, you can see that direct indexing starts off prospectively, interestingly, at about the 10 to 12% range, but then it declines to 5% the next year, maybe a 2.5% the next year. And after that, it's pretty darn small, maybe 1% of the overall portfolio. 130-30 approaches actually do two different things. First, you actually get a lot more realized losses in every single year relative to direct indexing. And second, because of the long short and the continual refreshing of the portfolio, you anticipate at least getting some benefit every single year versus it maxing out like direct indexing does. Now down to the bottom image. So on the bottom image, what this is illustrating is if someone owned a concentrated position in a single company, how could a 130-30 approach be interesting? Instead of having that 100% in the S&P 500 and bolting on the top 30 and the bottom 30, your company position is the 100. And then they borrow money and short sell to try to create a more diversified portfolio as well as create the taxable losses. And over a number of years, as they realize those losses, they intentionally sell out of your company position, which makes that extended 30 and 30 bigger and bigger, or more appropriately, that 100% that we started with of your company equity. Maybe that first year there's 10% of losses from the 30-30, so that goes down to 90. And now you have more funds available to effectively implement the 130-30 strategy because $10 of it have been pulled off into a direct indexing approach. On average, you might expect that you could get to 100% out of your company stock by maybe something like year 8. No guarantees, but that's a reasonable way to think about it. Next, let's talk about exchange funds, which are a powerful tool if you have too much wealth tied up in a single stock. Here's the situation. Let's say you own $500,000 of your company stock. That's a lot of concentration risk in one company. An exchange fund is an IRS-approved structure run by specialized providers. The idea is simple. They gather together investors who also hold large single company positions, and each person contributes their stock into a pooled fund. So let's say that 20 people each contribute $500,000 of stock. That creates a $10 million portfolio. On day one, you now own 5% of the entire fund, which is 20 different single stocks, instead of just holding your own one stock. That means before, your returns were dependent entirely on your single individual company. After, your returns depend on the basket of the 20 companies. It's not as diversified as the S&P 500, but it's dramatically better than being all in on one single company. So it can be a really powerful tool in certain situations. Of course, there are restrictions. First, there's a 7-year lockup. So you must keep your shares in the fund for at least 7 years to get the full tax benefits. Second, the diversification kind of varies. You get exposure to multiple companies, so it's definitely better than single company risk from that standpoint, but it's not an S&P 500 type of diversification. And then last, fees. Providers charge for access. Some funds have between 0 to 2% upfront fees and ongoing costs between 0.5 percentage point to 1% a year. But the bottom line, even with the fees and the restrictions, exchange funds can offer a tax-free way to swap concentrated stock for a diversified portfolio. And if you're sitting on that recently IPO'd company with a lot of gains, it can be an interesting way to get diversification without taking that tax hit. Okay, let's talk about a 351 exchange. These are not common, but it can be done, so we include them in the menu of possibilities. Here's what's happening. You can't just give all of your company's stock into this like an exchange fund would work. Rather, what you are doing is you have to be able to contribute a diversified portfolio. Up on the screen, it lists the requirements with basically no single company in the portfolio you give can be more than 25%, and the top 5 holdings can't collectively be more than 50%. So, for example, let's say you had $1 million portfolio you were contributing, and 250,000 of that could be your company's stock, and the remaining 750 would have to be a pretty well diversified portfolio. But if you have something like that, what you can do is a 351 exchange means that there are ETF providers, exchange traded funds, and sometimes when they're launching a new ETF, they can conduct a 351 exchange where individuals who have a diversified portfolio can contribute those. And once the ETF is launched, they get back shares of that ETF. So you haven't gained or lost anything from a value or from a tax cost basis standpoint, but instead of having a pseudo diversified portfolio, you now get one ETF, which again, for that 25% position, allowed you to get a decent degree of diversification for it, as long as you had other diversified assets that could go with it. Hedging your stock. This explicitly isn't necessarily a tax strategy, as it doesn't in and of itself accomplish any tax savings. But what it can do and can be interesting for is for any number of the other tax strategies that we've already discussed and that exist for capital gains handling, it can allow you to effectively buy time. So if, say, for example, you didn't want to take your company's risk exposure, you didn't feel particularly great about the company, but all else equal, you would rather realize the capital gains from that position next year or 2 years or 3 years down the road. If you work for a company, you probably can't do this because their insider policies don't allow it. But if this is stock you have in a former employer, hedging can be a really interesting approach. You basically dial in without dollars out to you a very narrow price band. Let's say if the company traded at $50 a share, you would sell a call, which basically means you sell away all of the upside above, say, $55 a share, and you'd use the money you got from that to buy a put, which means you basically protect yourself anything below $45 a share. So you haven't paid any money to put on this hedge, and effectively you've narrowed in a price band that no matter what happens, when these options expire, you're going to get at least $45 a share and no more than $55 a share. And now that you've done that, you can just sit and wait, because if next year or 2 years or 3 years down the road was really optimal for you, whether your anticipated capital gains bracket is going to be significantly lower, or you plan on relocating to a new state, i.e. away from a California or a New York to a Florida or Texas, Delaware, or somewhere else at 0%. Or if you had ISOs that you needed to get to a qualifying disposition. There's a handful of circumstances where this can be a really interesting way to effectively shift that tax burden to a future year. You do take some degree of stock risk in that 45 to 55 degree band, but if buying time is what you're aiming for, it's something you might want to consider. All right, let's talk about opportunity zones. These recently became interesting again with the tax bill that was passed in mid-2025. It really doesn't start to apply again until 2027, but opportunity zones are interesting because it is a way to defer a recognized gain. Pretty much all of the other strategies, you need to take a strategy before the gain exists. With opportunity zones, it only applies after you've recognized the gain. And here's pretty much how it works, is once you've recognized a gain, you have a certain amount of time in order to invest those gained proceeds into a qualified opportunity zone fund. And when you do it, you get to defer the taxes that you otherwise would have paid. So it's a way to shift the tax burden into the future. But it has a lot of other powerful elements as well. The first is if you keep invested in the opportunity zone for at least 5 years, then the amount of gain that you owe taxes on is reduced by 10%. Second, if you keep the investment for more than 10 years, the investments that the opportunity zone fund made over those 10 years, whatever gains, presumably that it has, become tax-free. The trade-offs here, however, are that opportunity zones tend to have much higher fees, and by definition, they need to invest in areas that might have less attractive investment dynamics. So it's not necessarily a free lunch, it's just a different tool that you can use. And last, the one thing I want to call out here is the bonus opportunity. Any time that you can defer taxes into the future is functionally buying yourself time. And in this situation, let's say you waited 5 years and then that tax bill of $900,000 became due. But let's say you had more than the $1 million that you were investing. With the other capital that you had, knowing that you were going to owe $900,000 of long-term capital gains 5 years from now, you could intentionally be using strategies like direct indexing or 130-30 portfolios to harvest losses, bringing those forward every year so that maybe you could even neutralize all of that $900,000 gain in year 5 because you had a number of years to try to plan to offset it. If you've made it this far, awesome. I'm really happy that you enjoyed the video and dove into everything that we tackled. Let's quickly recap what we got into. First, the biggest thing that you should be focused on right now is thinking through and developing your plan and your long-term goals. Every single thing that you do with your money should be in service of your happiness and maximizing your wealth for your family and yourself. And if you don't know where you are today and where you're trying to get to, it makes that tricky. Once you know that, then you shift over to what should you be doing with your company equity compensation. First and foremost, you want to be thinking through a plan and then implement that plan and stick with it. Statistically, again, about 4 out of 5 people, diversifying either immediately or over a selling schedule tends to be a pretty good route that we end up taking. But if that's not you, if you end up being more of those 1 in 5 situation, you should still be developing a plan and thinking about, even if you want to hold for a significant amount of time, what is your exit strategy if things go right or if they don't? Once you tackle number 1 and number 2, then we shift over to tax strategy. While there's more than 50 different prospective strategies that can apply to equity compensation, I highlighted 14 in today's video that might make sense for your situation, either individually or combined in various different ways. All of that being said, what I don't mean this as a shameless plug, this can be really complicated. Even figuring out your plan and financial goals, there's typically sophisticated modeling software that I use with my clients that can do things in a much more robust manner than many individuals can do themselves. And when it comes to a stock plan, this is likely more wealth than you've ever had in your entire life. And there's a major decision here. Having someone who's navigated dozens of people through this side by side, helping you think about the pros and cons, can be really powerful. And then when it comes to tax strategy, these things are nuanced and complex. I also want to flag in this video that I didn't cover everything. It'd obviously be impossible. Every situation is different. We got into what I think is the critical element that we wanted to cover today, but please don't believe that this is comprehensive. For more information, everything you need is on the screen. Our website is www.3040wealth.com. The academy is there at /academy. It's free, no login required. If you have questions, you want to chat through email, hit me up at kris@3040wealth.com. Or if you're interested and like to book a meeting, there's my Calendly. Thanks for watching. Bye.